Hi everyone, my name is Maria and welcome to my YouTube channel. Guys, today my guest is an investment guru. And when I say investment guru, I'm not kidding because this person is managing portfolios of huge amounts. And when I say huge amounts, I'm talking about 7, 8, even more figures, to be honest with you. Disclaimer, we will be talking here about finances, about investments, about how you grow on salary, but this is not a financial advice. So this is just a conversation. Hi, Yuri. Really glad to have you here.
Thanks for having me.
Could you please tell us about your background, where you're coming from, and why shall we trust you about investment?
Oh, you shouldn't trust anyone about this, to be honest. But yeah, as a short story, I'm coming from pretty much like humble background, got my bachelor and master's degrees in Moscow, then moved here because I won a few quite substantial grants, let's say. Had another master's degree and started my career at the global family office, which is managing about 1 billion in assets under management. But I had my career there for about 11 years, switching the roles between finance, investment, and risks. Effectively, I was working with a different part of finance, testing, and seeing how the trading side works, which investments probably are the best for the shareholders of the family office. And finally, after 11 years, I started my own practice. I've been doing it for a while by now, and this practice was fairly successful. Most of the clients of it are what I call pre-high net worth people. So successful professionals like you are, working in tech, finance, different other areas with, I would say, 6-digit salaries, bonuses, etc. And they have a big problem: how to manage their money, how to build up their wealth, gradually optimize the taxes. So I was guiding them through all these, let's say, caveats. And at the end of the day, the amount of people that I was working was fairly high, but whenever they come to me, I'm effectively solving their problems and they don't need me for a while. So as a result, just to provide me for a bigger pipeline, I recently joined like a big bank, which I would not disclose for now as it's still on process, but I will be building up the private banking with them, and I think I feel really excited about it.
I have so many questions right now. First of all, congratulations on joining a huge bank, and we're not disclosing which one for now, but once you are happy, once you're okay to disclose, we will definitely add this information on social media somewhere. It will be on your LinkedIn, and I guess our audience will be able to see where you're actually working right now. Also, you're saying you have a huge practice, you are supporting clients, you're supporting people of net worth,
family offices,
etc. Yeah. So when I'm saying that you are actually managing portfolios of 6, 7, 8 figures, I'm not lying, because this is true. You're working with this level of capital that actually needs some management when people don't understand what to do. But at the same time, what I really want to understand is actually personally for myself and for our audience as well, how do I grow my capital having just the salary? Because personally, myself, I'm working in a big company, I have my salary, I have my bonus on a yearly basis, but how can I grow in it? How can I become rich, basically?
Sure, it's I would say, $1 billion question. But the first thing to mention is, as you already said, that what we're discussing here is not a financial advice. You should be consulting with your independent financial advisor and check everything with them. But I think there will be a few good ideas just it's worth thinking about. So the first is what I would touch upon is the first and foremost the income part. So yourself and many of your listeners, they get some salary, sometimes bonuses. They apparently pay taxes, national insurance, and they left with some money. What you can do with this money is either spend them, partially you have to, and then what is left constitutes your savings. The main question is what you do with them and how you may change your, firstly, thinking and understanding of your personal finance in order to grow in the long term. So I can propose that we'll think about the person as a company. And the company has 3 statements, as everyone knows: income statement, balance sheet, and the cash flows. Let's leave just 2 of them: income statement and balance sheet. So effectively, income statement is how much you earn, how much you spend, including taxes, etc., and how much you left. part of this number goes to your balance sheet. And balance sheet, how much worth you have. By worth, I mean all your assets, less all your liabilities. So in order to understand how to grow this second part, balance sheet, you need to understand what comes in and out. On the first stage, we understood, okay, let's analyze our salaries, etc., analyze how much taxes we paid, and the money we have left. Main question is, okay, what we do with it? We can invest, we may just set aside as cash, but no one factually knows what to do, and that's why they come to the financial advisors. In terms of the strategy, so I wouldn't be talking just myself, main switch in the perception and perspective is to think about your wealth as a balance sheet. How much wealth you grow. How can you multiply this balance sheet part, not just income statement. It's not enough to earn more. It's not enough to spend less. It's important to accumulate part of your gunpowder, your savings, and use this gunpowder to grow your wealth.
So basically what you're saying, the first step is to actually analyze where you are. So open up Excel spreadsheet, put your salary numbers, your bonus numbers, also put your expenses, like for example, direct debit or like mortgage expense or maybe even commute expense. So once you have this understanding of where you are with your finances, only after you can actually decide what to do, right?
Correct, because, I mean, you cannot drive the car without the fuel.
That's true.
And effectively, one of the most efficient way to do this is the rule 50-30-20. So 50%.
What is this? Okay.
So yeah, 50% of what you have in terms of your incomes should go to your spendings. 30% are spendings that you need. The next 30% on your wants. So some kind of nice to haves. And
like
the
restaurants, for example.
For some people, restaurants is actually something really, really needed. For some other people, they don't even want it. But they have some other ones like travels or clubbing,
clothing,
concerts,
yes.
Of course, shopping. But what's important is 20%. These constitute your savings. And the more savings you have, the more gunpowder you will use to drive your wealth. So effectively analyze your incomes and expenses. This is the ultimate first step.
So once we have this understanding and we have this 20%, like you're saying, for example, let's say a person is earning £100,000 a year, so £20,000 a year should be savings, or this should be investment parts. No?
It's an interesting question because in the UK, people think in terms of the gross salary. But the most important thing is that actually we receive much, much less. So with 100K,
that's so true.
we're left about like 68K, I believe. And so which means that about 32% of your incomes go to taxes and national insurance. If you slightly more, and let's say this is another example of importance of understanding, there are some things like tax trap. What is tax trap? Is that some people receive income between 100 and 122,000, and this income actually goes not at 40% as they would expect, but at 60%, even 62 if you include national insurance, which sounds crazy. So if actually more than half of your income goes to the government. One of the ways to optimize it, and again, it's not a financial advice, is that to move this money to pension. By doing this, first you effectively reduce your taxable income. So instead of paying now 62%, you're delaying your incomes until you reach the pension age. As of the current, let's say, state of things and legislation, 25% you can take tax-free. Then you reach 55 years. I think 55, 57. That will be gradually increasing. I think in 2028, if I'm not mistaken. But as we are relatively young, I think this age will only go up.
Oh, to 100, probably.
Not as much, hopefully, but I think 60 would be like a nice guess, a good guess. So 25% goes tax-free, and the rest will go in your tax brackets. But if you think about it, tax bracket should also grow. Last review of the tax bracket was 2009. And you're well aware, so you pay 0% between 0 and 200, sorry.
To
between 1200K.
1200K, yeah.
Then the next 37.7K goes at 20%. Everything else up to 122 goes at 40%, and everything else at 45. So this is some kind of the ladder, but if you think about it, these boundaries, these brackets, didn't change for ages. I think the last change was 2009, if I'm not mistaken. If you measure how much now £1 worth, which you had in 2009, I think it would be close to £3, even more. So. But the brackets didn't change. So it's not like 36 grand now instead of 12 grand then. It's 12 grand still. So effectively, you are artificially paying more tax because your salary grows, even though, let's say, you're doing the same thing, your employer wants to pay you to match at least inflation. But you're ending up paying more in terms of percentage of your income. So anyway, we will not dive into too much, but what I'm saying is there are multiple things, as I mentioned, the tax traps, the pros and brackets, etc., which you can do and you can optimize. You may use pension because whenever you draw your money at the pension, likely the brackets will be higher, 25%, should go tax-free if nothing changes, which is unlikely. And the percentage that you'll be paying over there could be 25, 30, not 62 as now. So this is some kind of the strategy of delaying income, which many people use, which is completely legal. It's not tax avoidance, it's tax optimization. But you need to know what's going on your income side to be prepared, because if you miss the deadline end of the tax year, you can do absolutely nothing, because you can do only pensions, salary sacrifices only up to the 5th of April, if I'm not mistaken.
5th of April, and the financial year, it's the beginning of the financial year,
this
right?
This is the end of the tax year.
This is the end of the tax year. Okay, right. So the person, let's say, like as an example, earning £100,000 a year, in reality, it's actually less, like you're saying, because of the taxes. But when you're saying that we can delay our income and move it to pension, do we consider it as investment in a way, or it's separate from investment?
Yes, true. I think the easiest way to think about it is in boxes. And we need to go back to this income and balance sheet, like your personal one. So let's say you wrapped up everything, you understood your income, how much taxes you're paying, you already optimized everything on the taxes side. Let's say if you used to have like 115K in your incomes, you moved 15K to your pension, and you effectively, instead of paying 62% on this 15K part, you paying much less right now. You're effectively paying 0 because you'll be drawing it later. But what I'm saying is, once you understood this, all the tricks about growing wealth are in the balance sheet. One of the biggest misconceptions, especially like I would say Eastern European background, is that my home is my main asset. I can sell it anytime. I can do, it grows in value. The property never goes down. Property value never goes down, which was proved to be wrong in 2007. But my point is that many people consider this as an only asset. But if you think about the implication of this decision, let's say you save money all your life, you pay off your mortgage earlier, you effectively, at some point of your life, you have the mortgage fully paid off, and you have your house as your main asset. What you can do with it? Does it value grow? Yes. But
prices grow at the same time.
But price is growing at the same time, so you need your assets grow faster than your house. And if you look at the real estate market in general, and compare it, let's say, with the stock market, American stock market, real estate market growth was much less. Let's say S&P 500, if you would invest in a passive fund, would be much more, let's say, successful. Your investment would be much more successful. This is one thing. Second thing, you cannot just take this money off your house and invest. You potentially can remortgage, take out part of this money and invest, but this would mean that you still will be holding this asset as your main crown jewel of your portfolio. Um, the let's think about this way. If something happens with your house, you're left with nothing. Yes, you could have the insurance, but there is always a risk that this insurance doesn't pay off. You could have, let's say, need of drawing 100K. In this case, you would need to go to the bank and ask for the mortgage for this house. But just imagine that you went, I know, a year ago. Then the mortgage rates were about 5%. Would you be ready to pay 5% just for this effectively debt of 100K?
Of course not.
Questionable.
Questionable.
Yeah, but definitely not beneficial for you. So instead of doing this, I think the smarter strategy would be asking yourself what you actually want. First thing is your immediate needs, then your short-term needs and long-term needs. Immediate needs, some people call it the financial cushion, the rainy day funds. So normally people save from months to 3 months just for immediate available cash in case something pops up. This is really necessary, but I think the realistic goal would be having about like 9 to 12 your months of your spendings, not exactly the incomes, because some people receive income which is far beyond their expenses. Once you go and close this necessity of yours, like immediate needs, you have this immediate cash. You may breathe now. If something urgent happens, you have
covered.
this money to cover. Yeah. Then we look at some short-term needs. Let's say you planning to get married, have kids, I don't know, pay for the nursery, etc., etc., or buy the house, get a mortgage. For the mortgage, you need a deposit, plus you need a credit history, so you need to be prepared. And you need to tick a lot of the boxes. So assuming that you have, I don't know, your monthly spending is $2,000, your, let's say, 10 months cushion will be 20 grand, and you're fairly comfortable with this, you set it aside. You may use, some people normally use the less risky instruments like the deposits or money market funds. Money market funds is just a bunch of short-term bonds, so which many money market funds just holding for on your behalf until the expiry. So there's not much of the market risk, let's say. But again, they still a bit risky.
How about ISA? Is it also a tool for that?
I would say ISA is a type of the instrument rather than the type of the investment.
Right.
So this is how you grow your money, not where you invest in. I think I'll come back to the ISAs a little bit separately. But on the short-term side, what I would do is to understand the goals, how much money you need for each of these goals, and start effectively saving on them. Again, as your time horizon is relatively short, from 1 to 3 years, you wouldn't use the very risky instruments like the, I don't know, the stock market, passive funds, investing in the stocks and shares. Some people use ISA on this part for the tax reasons. Let's mention what ISA in general. Yeah. ISA is a separate account where you can deposit up to 20,000 a year, and any income that you gain on this account, either capital gains or savings income, coupons on bonds, it will not subject to any taxes. Unfortunately, that in the UK, the most tax-heavy instruments are the safest one. And this is the crazy thing. I was writing about this about a year ago, that effectively the tax policy is pushing richer people to get richer and poorer people to be more cautious. And as the stock market was growing pretty much the past 13 years, people who invested in the riskier investments, they earned more. But why the tax legislation pushes it that way? Because the current capital gain tax rate is maximum 24%. Plus you get 3K of deduction from your profits. So let's say you bought the stock for 10K, you sold it for 100K, you're not paying any tax on 3K, and effectively 87 goes at 24%. But what if you, instead of investing in the stock, which was very risky, but so high risk, high returns. Instead, you, let's say, just put the money on the deposit and you get savings income on this. Savings income just added to your maximum tax band and treat it as your income. So effectively, if as most of the people like in London, they are in 40% bracket. Most of the income comes on the top, so it's 40% income tax plus 2% national insurance. So effectively, your savings income will be taxed by 44%. So effectively, half of your savings income will go to the government.
This is so good to know. I think audience doesn't also know about it. I don't know about it as well. It's such a good information that you're sharing, because obviously we all think that I will put it onto savings account. I will just like accumulate some.
Fine.
Yeah, I'll be just fine. I will just accumulate money and then I will just withdraw them from my account and maybe use them for, let's say, for my kids' education. Apparently, no, you can't do it.
But imagine just you investing like on your deposit, you're getting 4%. On paper, but in reality, after tax, you get only 2%, which is crazy. Moreover, for people who got kids, there is a special threshold, 99,999,000
A year
of your taxable income. I know that this is fairly ambitious goal for most of people, but there is like a magic £1, which does the trick. So effectively, there are 3 hours which you get as a parent. For your kid, for the nursery, and if I'm not mistaken, like 30 or 20 hours which you get. The market value of this 30 hours is about 12.5 grand a year. So, in order to make this money, and you're already like in your let's say higher than 100K, you're effectively paying 62% firstly, and then 47%, 45 plus 2% of the national insurance. So effectively, you need to double your pre-tax income in order to get this.
In order to go to the nursery.
So effectively, 2 kids, 25 grand, roughly. You need to earn 50 grand extra. So if you earning 99,999 of your salary, bonuses, some other, let's say, income style things like savings income, or your benefits that you received, and suddenly you get this £1 extra, you're losing your allowance. You're losing this 30-hour allowance, and this costs you 50 grand, which is crazy.
This is crazy.
So some of the people, they prefer, what you can do in this case, some people just prefer moving some of the money to pension in order to reduce their taxable income. And by doing this, effectively, they maintaining this 30 hours. This is just an example. But I think we like a bit diverted with what we were talking about initially. The main goal is what you can do with your wealth and how you can split into these brackets. So once you covered your immediate needs, you're thinking about your short-term goals. So for short-term goals, again, like as a mortgage, you need to gradually increase your wealth. So using ISA is very useful over here, because if someone pays you on your ISA and you, let's say, moving this money to money market funds, paying you, 4 or 5%, you'll be getting the full 4 or 5%. If you're keeping this money outside ISA, it'll be half of this amount. This is how you potential tool of meeting your, let's say, short-term goals. But for the long-term goals, I think this is the most important. This is how you grow your wealth. This is the part about high risk, high returns. And this is where probably the help of the financial advisor is the most useful. Most of my clients, which I was helping on the financial guidance side, I call them pre-high net worth. So they are successful professionals working, let's say, primarily in finance and tech, because this is where you find like a big salaries. But what they're going to do, they have some cash left, but they're really afraid to invest, and they don't understand how the whole market works. But to be honest, no one knows. So we don't have a crystal ball. The most important thing over here is to understand that long-term investing has nothing in common with like checking your phone every single minute if the market went up or down. It's about understanding the optimal allocation. By allocation, I mean where you invest, implementing this allocation, using the most tax-efficient tools, and leaving it over there. That's all. Time does the thing. Because Albert Einstein called the compound interest the eighth miracle of the world.
Compound interest rate, you mean the percentage itself?
So compound interest and normal interest, the main difference is, let's say I'm paying you 10% on your money that you're holding with me. You brought me 100 quid. So next year I'm returning on this 110 pounds. But next year you're investing not 100, but 110. So I'll be paying you not 10, but 11 pounds next year. And the next year even more. So
the more you bring, the more you get.
Exactly, but it goes not as just a linear growth, but exponential growth. So if you keep the money in the relatively successful investments, well-diversified portfolio, in theory, it could go up because the economy should feed the population. In order to do this, the businesses should succeed. In order to do this, the government need to find some options on the main drivers and to incentivize the business to do so, to give job to the people, to let people earn money and spend money, etc., etc. Again, there's no guarantee. Past performance is not a guarantee of the future results. But again, thinking about the long term, what's here? It's your pension. This is the investment side of your ISA. Let's say you already met all your short-term goals. You already have the mortgage. You're relatively happy with your interest rate on this mortgage. You are, let's say you have kids, but you have enough money to cover the nursery because either you have this money on your current income.
Or maybe both partners work as well, right?
Yeah. I mean, we're in London. I think both partners normally work
They do.
just to afford anything. Yeah,
just afford nursery.
Yeah, true. But the whole point is then you start building up the ISA. So as a rule of thumb, again, the financial advisor needs to look and dive into your situation particularly. But whenever you have ISA or normal account, if you can use ISA, do this. Because any income that you earn under ISA is tax-free. But you cannot top up more than 20 grand per year. If you gradually accumulate all your income in ISA, effectively paying zero tax. As an example, there is a wonderful tool called Junior ISA. I call it wonderful because this is how you can get your kids to Harvard and Oxbridge.
This is very important, guys.
Current legislation allows you, let's say there is a household of three, mom, dad, and the kid. From the day one of the life of the kid, you can open a junior ISA for your child. What it means that you can put in 8K every year. You can invest it as your horizon is relatively long. This allows you to invest it more aggressively than normally. But again, you need to get the financial advice.
But when you say invest, is it you investing or is it done automatically within the application?
Normally, there are many tools right now as, let's say, passive funds, which allow you to buy the broad market. And if you believe that this passive fund would grow, this could allow this just to provide you with this exponential growth, to just gradually increase the investment. So by saying like 8 grand a year, what you can do, you can just split it across the whole year. So leaving a part of your net income and putting it part on your junior ISA, part on your child junior ISA, and the part on your personal ISA. So again, for the household, you can put in 20 grand for the mom, 20 grand for the dad, 8 grand for the kid. And for most of the people, let's say for the household, it should cover the savings part of your assets.
So when you mean for mom, for dad, and for kid, it means that separate ISA for mom, separate ISA for dad, and separate junior ISA. So
junior ISA.
In the household, 3 ISAs basically.
3 ISAs, yeah. But if we set aside the 2 ISAs of the grown-ups, the junior ISA is what makes the trick. So if you put in, let's say, 8 grand every year, I was writing an article, so I can maybe like send you the numbers afterwards. But effectively, if you're putting in 8 grand every year, you think about, and you do it for, let's say, 18 years, right? What do you get? 8, 46, 144K overall of contribution, right? if it's 144K of overall contribution, you think that in 18 years I will get this 144 in the account. But actually, this compound interest makes a trick. So if, let's say, you grow 10% a year, you may reach closer to 600K on this.
Because of this interest.
Because of this compound growth. So how it works, you get the capital gain in this case on your kid junior ISA, then the fund reinvests this money into itself and then continue growing. Again, like it's not the linear thing. The market could grow up and down, but most of the markets, again, there's no guarantee, normally grow. Japan
on a long-term perspective.
On the long-term perspective, because you allowed normally to be riskier in the long term. Same applies, let's say, to the pensions. Pensions are taxable, then you draw them, not then you put the money in. But this is completely separate tool. My point is that in this 18 years investments, instead of getting close to 150 grand on the account which you just put in, and you probably could get like 200, maybe slightly more if you just put in this money to your deposit and be cautious. But if you could put it in more riskier investments, you actually could afford Harvard, Oxford, etc.
Amazing.
It's amazing because the only way how you can beat the inflation, especially what we can see after COVID, on paper the inflation is 3-4%. Real inflation is in reality is 10%. Especially like the grocery store, the basic basket consumption
much
basket.
More expensive now.
Much more. So effectively, in order to afford this, you need to grow really fast. In order to grow fast, you need to take more risks. Again, people are normally not comfortable with this, but this is how you build up wealth on the long-term investment side. And again, just to sum up, the first stage is to understand what you need in terms of your immediate needs, build up the financial cushion. Then the next step on the top of this is meet your short-term goals. Again, here the instruments are normally more cautious. And then you look at your long-term goals. And long-term goals is how you grow your wealth. So once all of these are structured and met, you may concentrate in growing your long-term portfolio. So you concentrating on putting most of the money in your ISAs because this saves money on your tax side. You use your pension because this optimizes your pre-tax income. You're getting less taxable money now in order to get more net money in the future. And again, you need the proper financial advice because I mentioned allocation. So the scientific research of the 90s and 2000s, they indicated 91% of success of the portfolio lies in allocation. These allocations should be properly maintained and rebalanced. So let's say some people could say, okay, I'm confident in the US tech market, and I will just put all my money in my company. Let's say they're working for one of the Max 7, Google, Amazon, Facebook, you name it. So let's say they put all the money in there, and they just expecting that their company will grow. It could happen. No one says that it's not possible. But if you think about it, where is your risk? All your salary comes from this company. All your stock options are in this company, and now all your savings are in this company.
As well. Mm-hmm.
If something happens, there are many successful stories of, the most recent, I guess, was Wirecard. It was the fintech in Germany, which turned out to be some kind of fraud. And effectively, it went to zero from quite substantial price, but they used to be crown jeweler of German market.
So we always have to remember that it might happen. It's it's not a gamble, but it's still, you never know what the market is going to be like, what's the political situation, what's the economy is going to look like. Yes, the companies might be growing, but at the end of the day, there might be some obstacles on their way, and they might go down or they might go up. So we always, when investing, we have to remember that something might happen. And also, when we're talking about investment, I feel inside that there might be some sort of a fear personally for me in investing because of this uncertainty. How to overcome this mindset? And I guess I'm not the only one who's got this mindset.
I think the best thing is to develop another fear. Because the biggest fear is that you will not have enough money then you reach this goal. So currently, young professional, time is on your side. If you allocate your savings properly, even though they could go down, if the portfolio works well, it's properly balanced, it could grow in the long term. Even though, let's say, let's look at the American market. American market went down for up to 50% at a certain point. But assume that some people just put in, $1,000 or pounds every month in this fund. So at some point, when the market was down, they were buying this market cheaper. And the market continued to grow. So their average price, if the market goes down, the average price of acquisition, average cost per share will be much lower if the market goes down. If the market goes up, the price of acquisition also goes up. But the biggest fear is that if instead of investing in the riskier investments in the stock market, which reflects, I would say, success of the businesses in the global companies, in the global economies, you will be investing in something safe. Deposit accounts never beats inflation, full stop. Money market funds as well. Plus, these safest instruments, they taxed heavily. Then I mentioned that rich people are forced to invest in risk investments is because if your salary is 100K plus or 122K plus, you're already in 45% tax bracket. If you get any savings income, deposit income, it goes to 45% plus 2% national insurance, 47. So half of your income will be gone. So people are choosing to invest in the stocks and shares, where you normally do not get much of the ongoing distributions, like growth stocks, technology companies. They have potential to growth, but the income on this growth will be taxed at 24%, which is a capital gain tax. So they're halving their tax liability by introducing much higher risk on their portfolio. As a result, portfolio of the richer grows substantially faster than portfolio of cautious, but let's say investors with lower income.
Doesn't mean that we're also scared of investing into, let's say, stocks, only into stocks. Because I personally feel that if I invest everything, let's say, into this tech company, something might go wrong and I'm going to lose all my money. So in order to overcome this fear, maybe I could invest in something else, maybe like cryptocurrency, or I could maybe gold, diamonds, metals. What is your take on that?
So I think that the best way is to approach again with your financial advisor, because you firstly need to evaluate your risk appetite, your goals, your current wealth. For some people, then they're thinking about their wealth growth. And now, this really important part, they don't understand how much they need. Understand how much money you need, how much money you spend right now, extrapolate this to inflation and or your future lifestyle, and then you'll understand how much money you need to spend, let's say 20 years from now. Let's say it's 30 grand, right? So we can run like a brief calculations, but I know if you, let's say, need the real inflation is 10%, you would likely need enormous amount of money, close to 100K. But in order to offset this inflation growth of 3%, you probably need another like 5. But let's say you need the portfolio X. This is the money that I need. Nice. If, let's say, you need distributions from this portfolio of 50 grand in the future, which will totally cover your expenses. How can you build up this portfolio? How much money you need in this portfolio and where you need to invest? Realistically, by that time, your risk profile will be really, your risk appetite will be really low, because the older we get, the less time we have for recovery. Let's say if the stock market goes down, we couldn't just have, let's say, 10 years
We
for it
can't
to
wait.
rebound. We can't wait. So likely the growth rate over there will be, I don't know, 6%. 6% less like nominal inflation of 3%, 3% growth. So you actually can derive, if let's say you get 50 grand, how much money you need to get on this portfolio. As a rough calculations for, then if you buy annuity with your pension, you'll be getting 30 grand every year until the end of your life. But this is 30 grand every year on a million portfolio. Is it enough or not enough? So it's difficult to, let's say, run and explain it without the numbers. But firstly, you need to understand how much money you're spending right now, multiplied by inflation. Inflation plus one power the number of years. Then you expect to get your portfolio drawn, and then you will be able to evaluate this small amount of distributions. Having these distributions, you need to estimate how many years you'll need this distribution. Let's say if you decide to retire at 50 and you want to live until 100 years, you need 50 years of this distribution. And then you need to check if, let's say, £1 million will be enough for you to get this distribution. So £1 million will get you net, let's say 6% less 3%, 3% net. Is this 3% on 1 million, 30 grand distributions is enough for you in the future? Likely not. But
you will never understand this without a financial advisor or investment advisor, because you really need to understand the mechanics behind it. You're explaining all these calculations, the tools, etc. But just an ordinary person who wants to grow the salary might not know anything of that. So I guess it's the advice here is really go and find the broker or investment advisor or financial advisor who can help you with this and grow your salary. In your experience, what are the common mistakes that people make when investing?
I would say, I will just count my mistakes, and I just started my, let's say, investing, and I've done many of them, to be honest. First of all is that I need to mention that most of our mistakes come from two sources, our cognitive biases and emotional biases. And both of them come from our nature. Because cognitive biases is the way we think. So as an example, there is a bias called confirmation bias. You probably noticed that if we have a certain opinion, we're trying to look out and the confirmation of this opinion, any other opinions which confirm our point of view. And this is normal. This is in human nature. On the emotional bias side, let's say, there is an endowment bias. Then the person selling their business tend to evaluate this business higher than the outsider who just wants to buy the business and, let's say, uses the financial cash flows of this business only, not, let's say, how many years the owner of the business spent to grow all the operations. My point is that cognitive biases are potentially possible to manage. So you understand where our brain tries to trick us, and then you do make the decisions. Emotional bias is almost impossible, and that's why you need the outside person who just explains you why you tend to make the certain mistakes. So let's say my mistake was that I invested in the individual shares. Likely that, again, the research normally shows that the active management, and I try to cherry pick the successful stock, in the long term, likely to underperform the passive management. Passive management and is then you invest in a broad index, let's say buying S&P 500 or whatever. Normally, I used to pick the stock, bought it, and some of them were very risky because when you're buying the stock, you see, oh, this stock just crushed 40%. There is a good enter opportunity, and then you realize that it goes down for another 50, for another 50. So yeah,
Keeps going down and down.
Yeah, so effectively, like you already will be like on the watermark of 30% in this case, and which is crazy. I mean, but the main idea behind this is no one teaches us to how we should deal with our finance. Normally, the governments are interested in showing us the discipline to pay taxes, but not to allocate the savings in a way then we will be growing in the future and be more financially independent. So again, like going back to the main mistakes, I would say that investing in individual stocks is fairly risky. Consider your concentration position, especially if you receive the good salary and stock options from your current employer. Maybe relocating part of this exposure to the broad market to the different assets would be useful. Secondly, do not underestimate inflation, because you may use short-term investments like deposits on ISA or money market funds to meet your short-term goals, which is okay because let's say you need deposit in a year and you don't have time to wait until the market recovers. But if you think that, let's say, investing cautiously pension could meet necessarily your financial goals, this would be tricky. So this needs to be properly balanced between the riskier investments and the safer investments. The asset classes that you mentioned, I think the easiest that the people understand stocks, general stocks. In fact, you become owner of this business and you share and you have the rights for the share in income. The more successful the company means that this company earns more money in the future. Why Maxam, let's say, growing right now is because their earnings quite high, plus because they invest a lot in the certain technology improvements like AI, but they invest massive money. Let's say the project Stargate is 300 billion. It's hard to imagine this kind of money to spend for the group of the companies just to develop the certain tools. But what it means, they believe that by spending money right now, they will have high cash flows 20 years down the road, 10 years, 5 years down the road. And investors believe them because if the stock price goes up, this means that investors are buying this information and probability that in 5 years, this company will earn this much. This is the first type of the asset. Second type is effectively debt. The bonds, investment-grade bonds, the bonds of the good companies. Some people also consider riskier high-yield bonds. They're paying you more, but the risk is higher. There are other assets beyond the traditional, which is called alternative assets, which also include commodities like gold, crude, sugar, soft commodities.
Interesting.
Normally, they are less correlated with these asset classes. And if, let's say, stock market goes down, historically gold
will go up.
Will go up because it potentially is a good safe haven for the difficult times. And let's say now the massive growth in gold is linked that the governments are buying more gold in the case of geopolitical and in general economic instability and volatility in the current markets, uncertainty. More uncertainty, the high gold price, but again, that's no guarantee. But again, you're trying to balance different part of your assets in a way that they create the certain returns acceptable to you based on your risk profile, but at the same time, they have less risk than investing in separately in there. Let's say if you just invest in the stock market, your volatility will be massive. If you combine a few assets, you still pick up the growth of the stock market, but the changes
they're not as
severe as they could be if you would invest in stocks only.
Brilliant. Thank you, Yuri. I could go on and on with you talking about finances and investment and managing all the portfolios, but we're out of time. So thank you so much for coming. Absolutely enjoy the conversation.
Thank you.
Cheers. Thank you.